and welcome to FinTech Leadership Series by India FinTech Forum. I am Ayushi Khaitan, and I have with me Mr. Vinay Mathews, CEO and founder of Faircent. Mr. Mathews started his career as sales manager at the Indian Express. In 1998, he joined Rediff as the head of commercial alliances. Before incorporating Faircent, he was the national head and associate vice president at Times Jobs. Welcome, Mr. Mathews. We are glad to have you here with us.
Thank you so much.
Yes.
Thanks for having me.
To begin with the interview, my first question is, Faircent was founded in 2013 when internet penetration was still low in India. What made you believe in the idea of Faircent almost a decade ago?
See, the internet penetration was not very low in India back then. It was more about transaction customers were very low. Okay, so they weren't customers transacting online, but there were job sites, there were matrimony sites, there were a lot of classified sites which had a large number of customers coming in, doing whatever transaction they had to, right? So eBay, all of that was there, right? So it is just that the users were there, but the customers weren't there. So that's a fundamental difference. The users were there. So from that point of view, I think customers were ready. It was a question of just getting these customers on to kind of doing transaction, right? And not just us, a lot of companies during that time were trying to kind of do that, right? From Flipkart to Amazon to Make My Trip, all of them were doing transactions on their platform. So we were another organization in the financial services space, wanted to do kind of both sides, customers on both sides transact to kind of make the commerce happen. So I think Faircent was launched at the right time. It's just that in the fintech, I think the fintech word was not coined when we launched this. So in the fintech space, I think we're the early ones to get in. And that's primarily because we had the background of, at least me and my founder had the background of conducting internet business for the last 20 years. So that gave us the leverage of starting Faircent, and we kind of used the same principles that we used in Times Jobs or Magic Breaks or Simply Mary, the portals that we were managing in Times. We used typically the same principle, the demand supply two-sided marketplace principles to kind of start Faircent.
So Faircent was the first RBI certified P2P lending platform. What is it that differentiates Faircent from other P2P platforms?
The first differentiator is the scale. We had a whole lot of scale before even the others joined. This entire P2P business, right? P2P lending business. Also, with respect to the technology, I think we had far better technology than what others had. We won global awards for our technology, not just in India, and it was recognized by Microsoft, NASSCOM. We were incubators under these large organizations. So I think tech played a very big role with respect to and RBI was looking at organizations which had a 500 crore plus NBFC tech capability, right? So I think at that nascency itself, we had a great technology because we came from a tech background. So it was easier for us to kind of get this together. But having said that, we built a platform which was scalable, globally, recognized. We not even, just got awards. We got invites also from, different parts of the world to come and, present Faircent in their respective regions. So I think from that point of view, that set us apart. That was the technology part. The third thing I think is if you look at any business, right? So if there are paying customers, it makes the whole concept or the whole idea even more genuine, right? So we had all customers paying right from the first day itself. We had paying customers. We had a decent tech team. We had a lot of investors backing us. So I think these are some of the points that made us completely different than what our competition was. And competition, even today are very small. They don't have a lot of great investors like we do have. So I think these are some of the mark differentiators which said RBI gave us the license. And after our license was issued, there's a gap of some 9 months. Then they issued the second license.
Thank you. My next question is basically digital lending is characterized by relaxed KYC norms, which makes it easier to function in this domain, but it also increases the risk for the company. So,
Hmm.
how does Faircent mitigate the fraud risk to the company?
So the KYC norm is not relaxed. Just to kind of qualify that, it is still as if the RBI definition of eKYC or electronically if you're doing KYC is as stringent as what regular KYC would be. Right? It's just that you are meeting the person there. Here you are meeting the person on a video, right?
Right.
And also the documents that you pick up of these individual borrowers who you're wanting to kind of onboard, you pick up the documents from third party. You don't pick it up from the customers directly. So when you pick up the document from third party, be it PAN, Aadhar, we validate that to ensure that this is the right person that we are lending to. Plus, we also do a penny drop to figure out the bank account, whether that bank account is registered in that particular customer's name or not. So there are many checks that happens to kind of mitigate fraud. As an organization, the customer journey goes through some 120 APIs, so which we make the customer's life easy, so that at the back end there's a lot of technology which is working to validate the customer and mitigate the risk completely, right? So from a KYC standpoint, I think as per whatever the RBI's regulation is or RBI's norms are with respect to KYC, digital KYC, we are adhering to that, and that is it's not something which is loosely defined by RBI. It's very, very, very precisely and defined as you have to ensure that the customer that you're giving out loan to is the customer that you are talking to and the customer that is coming and applying on your platform. So I think that we validate through a lot of API integrations with various organizations. We typically don't rely on what customers are giving us the data for.
So, just a follow-up question to that.
Yeah.
How difficult is it to make the target market believe in the credibility of digital lending?
Target market with respect to the borrowers.
Both, because it is a P2P
Yeah.
platform. So,
So from a borrower standpoint, I think we are an organization which would lend to customers which are a shade lesser than a bank would lend to, right? So banks would lend to, let's say, a super prime customer. We would, lend to customers which are near prime, and that segment, it's a pretty large segment, and this segment is, currently, or for that matter, it's addressed by a lot of NBFCs. There are close to 8,000 NBFCs in this country. Many of them do unsecured loans. So this market, this NBFC services this market, right? It's just that we're trying to kind of eat into their share and wanting to make this entire process for the end customer digital, right? It's a huge market. India has a huge market in terms of credit penetration to be done. The banks and then large NBFCs are only able to penetrate 7 to 8% of the population. So there is an open market. A lot of players can come and participate and get their piece out of whatever the process is currently happening, which is quite broken. So I think from that point of view, it's easier for customer. That is one. Second important point that you have to realize is that we are a P2P platform. So we kind of take the money from the lender and we kind of give it to the borrower, and in between we make some margin. But the costs that you look at is much cheaper than what operating the business cost is much cheaper than operation of a bank or an NBFC, right? So that advantage we pass it on to the end customer. So basically, customers do get a cheaper rate of credit from us. That's a huge differentiator. And that is the reason the customers, the borrowing side customer comes in, participate on our platform. And there is a brand, there is a credibility around that to kind of build. We kind of take the customer, we top up the customer is performing well. So all of that happens, right? So from that point of view, I think, as I said, there's large markets, a lot of customers wanting, and if they can get it in, fast and very, simpler and a smooth process, I think they're more than happy to kind of come in and at a reduced interest rates, they are more than happy to, and transparent interest rates, they're more than happy to kind of come and participate, right? On the lending side, it's a story of investment, right? So lenders come and invest. Now, that is a story which is going to take its own time. It's not going to shortchange. People will try it out, they'll figure out, understand, they'll invest, get the returns, they'll come back, put larger investments, all of that will happen. So that is the reason even RBI is trying to kind of increase the rates increase the lending limits gradually. Right, it was 10 lakh rupees earlier. They made it to 50 lakh rupees in the last 3-4 years. They did that. So those indicators are good enough for you to understand the customers are having a lot of benefit to, or lending side investment. Customers are getting a lot of benefit to the investment that are putting, right? So I think so that journey is of trust. That journey is of customers getting the returns back. So all of it is there, right? So that will take its own time to build. I'm sure some of the customers will not be very happy. They will go back, not come back. Some of them will be sitting on the fence watching what's happening, and some of them will participate in the near future. But there will be some who will be participating now and making returns. So as you go along, the returns might come down. Right now, the returns are a little higher. As we go down, some part of it we're seeing after COVID. We saw this coming down a little for the lenders. On an average, it's kind of coming down for the lenders. So these things are part and parcel of the journey. So if mutual fund took 30 years to be what it is today, how much participation is there today, we all know. Similarly, P2P lending will take, if not 30 years, at least 15 years to be what the size at which we all want it to be.
So, as you mentioned about COVID came as a blessing in disguise for most digital and tech players.
Yeah.
So how did it impact Faircent?
So we had two advantages, in COVID. One was that investors' money definitely came up a little more than what we expected, right? Because people had the money, they didn't have avenues to kind of spend the money. So they were looking at various alternative, traditional, non-traditional investment class to invest, right? So that money kind of swelled during the COVID time. That was one clear benefit that we got. Second benefit we got was that since banks and NBFCs weren't lending, okay, some of the good customers started to kind of come onto our platform, which typically would have been addressed by banks and NBFCs, large NBFCs. Those customers started to come onto our platform. So we had a great time during COVID. In fact, we grew a lot during COVID, primarily because of these two reasons.
So, how do you see the future of Faircent? Moving ahead, what plans do you have for Faircent?
So I think Faircent is a great story. It's a people to people. That's what if you look at the world economy, organizations which are built out on the tech play, you will see a people to people transaction which is happening. Okay, be it Airbnb, be it Uber, Ola, Swiggy, Zomato. All these are people wanting to kind of transact with people, right? This is going to just grow in the near future. So finance is also one of the things that people who want to kind of make money off the people who are in need of money, right? So this will kind of grow. Not only organization, but I think government will also play a role here, like the way it happened in the UK. In UK, what government did was that people investing in these kind of platforms, especially if the money is going to be small businesses, micro businesses, government started giving tax breaks. Yeah? So those tax breaks helped them to kind of come and invest more. Okay, those things. Government started investing also in the UK. British Bank invested in these kind of platforms. So that also made the journey even more better and bigger, right? So I think in future you will see all of that happening in India as well. There will be tax rebate. There could be government participating. All of that will happen. So this is just the starting of a new way of lending, and government wants this primarily because otherwise government what it does is that it takes the money from public. It kind of then moves, or various ways it takes the money from public through tax or whatever. Then it moves to public sector banks, and from the banks it comes to the end customer, right? So, and during that change of hands, there is cost which is involved, and two, there is mismanagement and lack of as you call information translation. All of that happens, and because of that, you're not able to get the kind of returns that you expect, right? So one of the reasons the British bank started participating on these platforms was very transparent. You get to know exactly where your money is going. And it helped government to kind of make the money also, right? So in this case, government could make money as well, right? So I think, so from that point of view, I think it has a great future. And as an organization, we want to kind of build this out really big. Another 2-3 years, we want to do an IPO. We are a profitable company. So I think the future from that point of view is fantastic for fashion.
So, lastly, you moved from a corporate job to starting your own business. what suggestions would you like to give to upcoming young entrepreneurs?
Okay, so I think one of the very important things young entrepreneurs should look at or understand is that a whole lot of things that you can do for your business or for your startup, is not to do with money. It is to do with you getting into it and doing it yourself, right? So I think that is one. So try and not raise money as much as you can early on, because you will give out a sizable amount of your business, right? Or equity of your company, which is not advisable. It's always better to kind of hold on to it, bootstrap it, uh, take money from your parents, or your family, or whatever, to make sure that you can outlast as long as you can with respect to kind of building your product, building your use case, getting some paid customers onto your platform, and then go out and look for investors to kind of put money to grow, right, or to scale. Okay, so I think that's one piece of advice. The other piece of advice is that never short sell your business to the investor. Most startups do that. I think that's a big mistake. You should have a sizable amount of equity with you. You should always value that, because I think on the hindsight, if the company becomes successful, and I think all startups would want to kind of see their company successful. This is the most expensive thing that you give out, right? Equity is the most expensive thing to kind of build an organization. So you're better off to kind of build the organization with the profits that you make, not give out equity. Equity is very, very valuable, right? So it's going to grow like tremendously in the next few years if you're building it out, right? And I think finally, there are many things that I wish to say of the experience that we've gone through. Finally, I think another important thing is that don't work for the investors, work for your customers. Is very important, because what happens is that when the investor puts a large money, he would have the agenda to kind of set. Probably he would have another investor company to kind of leverage. All of that happens, right? So you don't get into all that. You have to kind of build the business looking at your customers and work for them, work for the customers to kind of make it a profitable business, rather than work for the investors to kind of make this go. I'm not saying the investors don't look at that. I'm sure they do, but you have to keep an eye on what you want and what the customers want. I think that's very, very important. Don't get swayed by what the investors are pushing you to do.
Thank you. Thank you so much for the interview. But I would also like to use this platform to just mention that I'm actually conducting the research on the sustainability of fintech businesses. And I'm
Okay.
trying to understand how sustainable fintech lending in particular is. Because, I mean, in terms of NPAs and in terms of attracting customers. So if you could just throw some light on this, because how do you see fintech lending as a sector moving forward? Is it going to completely replace physical lending a few decades down the line, or maybe they could coexist in some form?
So as I see, fintechs are going to be enablers. Banks will continue to kind of lend. See, you have to remember, banks are very good in technology. Okay? It's just that they need to kind of get into the right zone to look at the right set of customers to start lending. Right? And lending is the space where you make maximum amount of money. Right? In all the other space, if you look at where you make a trade commission, banks are already there. Right? So it's just that in the lending space, they're not lending it out to a large set of customers, which are typically, they are, according to their scheme of things, risky customers, right? And they're rightly so. Right? They don't want to kind of take risks because they are holding on to public money. So the science which is getting built right now, okay, which the fintechs are building, I think banks will adopt over a period of time. So they will be late in the party, but when they're going to party, they're going to party big. Okay? So they will get into the lending space, or they will acquire companies like us, right? So to kind of backfit on the requirements that they want to kind of ensure the digital part is taken care of, right? So banks are investing. For example, we are invested by ICICI Bank. They have invested in us. Similarly, ICICI is invested in many companies, right? Strategically, they have invested primarily because they want to see the journey, how it moves, right? It becomes big, it makes sense, then they will also kind of start to kind of push more, right? And also the conversation that we're having with ICICI is like that. There are some strategic things that we're doing to figure out whether this is going to happen. So they're going to work hand in hand. And that's what I feel. You cannot work in isolation, especially in the financial services business, or for that matter, in the lending business in the country, because there are governance, there are rules, there are regulations. RBI has a very tight control on all of this. So it's better to kind of work with the regulator and with the existing ecosystem rather than being, trying to be a cowboy and trying to kind of say, I'm going to disrupt everything. It's not going to happen. It's not going to happen very soon. It's going to take a while, if at all it is going to happen. But also the rails, if you look at, the entire rails through which the money moves is going to be with the bank itself. It's not going to going anywhere right now. So RBI has not given anybody the access to moving the money without the bank's involvement, right? So if you look at any money movement which is happening today in the largest organization, the movement of money happens through the digital system with the banking, technology, right? So if RBI decides to stop that, all the fintechs will fail, right? So you have to work hand in hand with them, right? So you have to kind of understand their power, their disposition, their ecosystem, and accordingly kind of work towards it.
Thank you so much, Mr. Mathews, for the interview. It was absolutely great having you here. You provided us some really interesting insights into the industry. Thanks for
Thank you so
joining
much.
us.
Thank you so much.
Have a
Thanks,
great day.
Ayushi. Yeah, have a good night. Bye-bye.
Bye.